Hello, real estate investing fools. Today's spotlight is on Plotify, which is a newer investing platform. I'm chatting with Anish Malhotra, who is the co-founder and CEO of Plotify. He's been working in technology, real estate, and investments for over 20 years. He's helped convert new concepts into over $1 billion in revenue, including a stint as an early teamer at Bloomberg Tradebook, one of the original electronic trading platforms, and a team. He's part of a team that innovated a product which ultimately helped raise more than $7 billion for REITs, which is really interesting. He's dedicated his career to helping others really figure out the process of real estate investing and real estate management. And so his new platform, Plotify, makes it easier to own your own investment property and do it all through a mobile app, which sounds really amazing. So let's dive in. What is Plotify?
Hi, Deirdre. Thanks for having me on the recording. So Plotify is an investment platform for real estate investors, and it was really born out of my frustration and my partner's frustration with investing in real estate over the last couple of decades. So we've invested in multiple different markets across the world, including in the US and the UK, and some others, and have managed lots of real estate properties as well. Never done an investment that hasn't been full of friction or full of pain. And I'm sure many of your listeners and subscribers have been through the same experience. So when we created Plotify, we really were focused on trying to create a platform that would not just incrementally improve the investment process or the management process, but really provide a full end-to-end service, which goes all the way from selecting investable assets, making them instantaneously tradable or investable, and then provide full service management, not just physical property management, but everything that goes into managing an investment property.
So is this one property, one owner, or is this a shared situation? How does it work?
Yeah, it's a great question. We are not what is commonly known in now real estate investment universe as a fractional ownership platform. We focus on an investor wholly owning an investment property or a portfolio of properties over time, and we expect that to remain our focus. There are just so many layers of friction in that whole and direct ownership process today, and that's where we're going to spend our time.
Are these individual single-family rentals, or what types of properties are they?
Yeah, the focus for right now is single-family rentals in the US, and we're also actually already live with our first set of similar investment properties in the UK. So now our customers or members, as we call them, are able to invest in the US market and in the UK market. But single-family rentals, which are, as you probably know, distinct from other types of residential investment properties, is our focus area. And the reason why we started with single family rentals is firstly because we have a fair bit of experience at investing in single family rentals. Secondly, they are by nature and by definition fragmented assets. So single family rentals are typically standalone houses in suburban areas of second, third, fourth tier cities across America and the UK. And unlike multifamily product, they are these small individual assets, and that causes problems because if you want to construct a portfolio, you have to do lots of little trades to aggregate into a portfolio. But even more so when you own them, you now have to manage all these fragmented assets, and you don't typically get the type of economies of scale or efficiencies that you do with having, 10 or 100 or 1,000 units in a multifamily product.
So with UK and US, can US investors invest in the UK and vice versa?
Yeah, actually, on the platform, we already have members from 7 different countries around the world that have bought single family rentals in the US. And we are a little bit further behind, but I've already done our first trades in the UK as well. So the answer to your question is yes. So US-based investors can buy single-family rentals in the US and the UK on the platform.
Excellent. Do people have to be accredited, or are there any other income requirements?
Yes. So our target member is an accredited investor and has to self-certify as being so when they create an account on the platform. We also do already have a couple of clients who are family offices, and they are constructing portfolios across the US and the UK.
Interesting. So, which markets are you looking at right now as having the most potential for the single family rentals?
We've got our own proprietary methodology of how we select markets, and it's really driven by crunching a lot of data to understand where the right type of income and employment growth is being created. And that we take out all sorts of false positives and negatives against that data. But that's really the fundamental thesis. And how does that employment and income growth drive rental demand, which is going to then create momentum for investment properties, both on the rental income growth perspective as well as the home price appreciation perspective. With that said, we've got our kind of proprietary ranking, which is dynamic, of our top 20 cities across the US. Some of the types of cities that we're focused on are Pittsburgh, Atlanta. They're the first cities that we went to. Atlanta is a well-known destination for single-family rentals, but still has a lot of attractive opportunities in it. Pittsburgh is a market which has been we think underpriced for some time, and it's catching up a little bit now, but definitely has some great fundamentals. And there are several others like that, depending on whether our members are looking for optimizing yield or cap rates versus home price appreciation, or a balanced perspective.
It sounds like within the Plotify platform, you have different types of options. So, are there people who are investing for the long term? Are these buy and hold properties?
It's a really interesting question. I think what we're learning is that there is no one trend. The couple of interesting data points that we've observed, both with our customers and through the investment market at large. The first is that the average hold period of investment properties, and in particular single family rentals, is coming down, right? So of course there are investors all around the world that want to build portfolios generationally and to preserve wealth as well as grow it. But what we're seeing is that the average hold period is down from about 7 years to 4 or 5 years now. And much of that is being driven by a couple of different tailwinds. The first is that platforms like ours are making it easier to enter and exit the market. So it's becoming less clunky and with those layers of friction and sort of long timelines to purchase a property or sell a property. But the other thing that I think is interesting is that there certainly seems to be a shift in mindset amongst the millennial generation and below, where they are investing in cities away from where they live, sometimes because they can't afford to purchase in the city that they live in, to start accumulating asset value and trading out sooner, for example, if they want to buy their first home. So I think there's a lot of evidence to suggest that hold periods are coming down. On our platform specifically, we have no particular point of view, except for we want to make it as easy as possible for our members to be able to exit an investment as possible, and they can do that very easily on the platform, as you'll see in the subsequent screenshots.
So there's no hold period at all, or is it their recommended hold period or anything like that?
There's no recommended hold period. Our members are in control of when they enter and when they exit. They may choose to hold the property for years or decades or generationally. They may choose to exit in a short time frame. The only constraint to the period is that we are subject to securities law in the US and the UK, and in some cases, the purchase that they make, the members are locked in for 6 months before they can exit the trade. That doesn't seem to be a barrier to any of our investors. We don't think any of our members at this point are investing in our recommended assets to exit within a couple of months. It's really, do they want to exit after a year or 3 years or 5 years or 10 years?
Interesting. Are these properties transacted with a tenant in place, or is the owner supposed to get the tenant? How does that work?
Yeah, we, as I mentioned right off the bat, the vision for Plotify was actually threefold. The first was, how do we take a whole house, let's say in Pittsburgh, that's, as I mentioned, that's one of the first markets that we started in. How do we take that whole house and make it instantaneously transactable to our member, with everything wrapped into it that they would ordinarily have to do themselves? And that includes, to your question, making sure there is already a tenant in the property, so it's cash flowing. But it goes further than that. Not only do we make sure that there is a tenant in it, we make sure there is a property manager who is empaneled and has integrated workflows with our platform, so we can manage the property on behalf of our members, and all the other features of an investment property are wrapped into it. So insurance is already wrapped in, tax and accounting is already optimized and wrapped in. Importantly, we also make it really easy and flexible for our members to manage the expenses related to an investment property. So there are, anyone that's invested in residential investment properties, or any type of real estate for that matter, will understand that there are 4 line items in any P&L of an investment property that cause a lot of heartache. And those tend to be lumpy in nature and tend to be volatile, create volatility of income to the owner. And those items are vacancies, when there is no tenant, so there's no income coming in. Delinquencies, you've got a tenant, a sitting tenant, but they're not paying their rent on time or at all. Repairs and maintenance, and then CapEx not covered by insurance. You know, we've crunched enough data to understand that, and indeed managed and invested in enough properties to understand that if you look at the sum of those 4 items, they normalize on any given asset over a longer period of time. So let's say you take a 10-year view, and you know, those 4 line items will normalize to somewhere between 20 to 30% of gross rent. Similarly, if you take a shorter time horizon, let's say 1 year, and you look across many assets, it also normalizes to a pretty stable percentage of rent. So we've created a structure where we do 2 things. Number one, we operate a reserve fund on behalf of our members for each property. But then secondarily, we also flexibly fund that reserve fund if there are additional requirements, and allow our members to pay back from the rental income over a period of time. And that's valuable to our customers because it removes the need for capital calls, right? If I called you and said, "Hey, Deirdre, your properties needs to be funded with another $2,000 because the pipe just burst and the reserve fund's only got $2,000 in it," you know, that's a call that everybody likes to avoid. So we've got a structure that deals with that for our customers.
Interesting. So rent comes in every month, and then are people paid monthly or are they paid quarterly? And how are the fees taken out of that?
Yeah, so we do collect the rent on a monthly basis, as is customary with tenancy agreements. We distribute the net operating income out to our customers on a quarterly basis. And that comes with a very hygienic financial statement, which shows what's happened over the last 3 months to the property, including the smoothing out of income with the reserve fund and the flexible top-ups that we make as required. But meanwhile, we are accruing that reserve fund from the rental income for our customers.
And rental increases are sort of built in over time?
Yeah, so the market risk on rental properties, the biggest one is, of course, rental income. Is it going to go up or is it going to go down? Historical data shows that if you pick the right neighborhoods in the right cities, it always goes up and to the right. But our members do benefit from those upticks in rental pricing, which is passed on to them. The other thing to say about our structure is a very important value proposition for our members, and that is that we believe that on any given investment property, we will be able to generate a better P&L for our customers, even net of our fees, which are a modest asset management fee on an ongoing basis. And the reason for that are that we're able to generate institutional grade economies of scale across many of the line items that are relevant to the expenses in any given investment property. So, for example, because we manage many houses in Pittsburgh and Atlanta, again using the examples of the first couple of cities that we're in, we drive down the property management cost because we're able to give property managers several assets to manage, or dozens or hundreds of assets to manage. Similarly, we will insure all the houses by bidding out to various insurance companies and taking the best deal. All of those savings we pass on to our members in their investment properties.
So when you're buying in Pittsburgh and Atlanta, are you buying in specific neighborhoods? Are your houses sort of clustered together?
Not always, but we do try and benefit from some scale. If we like a neighborhood, we like a zip code, or neighborhoods, we try to create some kind of scale there. But the platform that we've created, which is, we think, never been done before, is that we are geography agnostic. So we can move neighborhood to neighborhood and manage with the same efficiency and go city to city. And it takes us a couple of weeks to set up in each new city. And that's a really interesting point, because single family rentals, again, just going back to the first couple of points that we made, they're fragmented by nature and therefore hard to manage and hard to get those efficiencies. And that's really been a constraint for a lot of individual and institutional investors in this asset class, because you really need to get that scale to generate the efficiencies and drive the P&L. Whereas the way we've set up our platform is we're not trying to recreate the physical property management. We're just trying to do it in a more efficient way by partnering with best of breed managers in any given geography. So that allows us to be more geography agnostic than most other platforms.
Interesting. So when you're buying these homes, are you doing renovations on them, or are you buying homes that are sort of turnkey?
Yeah, typically we prefer to buy assets that are already tenanted, or we can tenant them very quickly. So we stay away from development risk or even fix and flip risk. That being said, we do from time to time purchase properties that we think are really good investments that need a bit of love, a bit of a refresh, and so we're not scared to take that on, and we know how to do it, and we turn it around pretty quickly. But for the most part, we like to get assets that are already cash flowing.
Interesting. So then you're not competing against the iBuyers of the world trying to snap up homes.
Not necessarily, but I think it's certainly a feature of the market that there's a commingling of investment properties and owner-occupied properties and assets that are rife for fix and flip and turning around. So we do come across, as any other buyer would, platforms and institutions and individuals that are purchasing properties. But our model is very different to the iBuyer.
Excellent. So I've been watching the median home price. I'm sure you are too. It just hit another record. How is the this crazy market impacting your business model?
The first thing to think about is, having invested in real estate over a couple of decades, right? You see market cycles, entry points that may be better at any given time versus other times. But if you look over the long term, this asset class, based on the fundamentals in aggregate, will continue to perform and continue to do well. That's something that we believe. So if you are a long-term wealth builder, then there's no real issue in the ramp up on entry points right now. Although I am a big believer in making sure that you buy well and buy at the right value. From a business model perspective, I think there again are a couple of relevant points. We're seeing certainly a significant uptick in demand on the platform, as is evidenced by our wait list of members who are interested in purchasing investment properties through our unit. But what it also means is that we have to be more careful about buying well, right? When everybody's rushing and assets are being bid up, you really have to understand what you think is fair value for an asset, and there is probably a lower strike rate of closing on assets in this type of market if you're disciplined and you're willing to walk away from those investment opportunities. And we've got a very data-driven approach to how we think about assets that are the best opportunities, and that's actually our back end is driven by two proprietary algorithms. One is one that I mentioned before, and that's how do we pick cities and neighborhoods within those cities. And the second is, once we've picked the zip codes within the cities that we like, and we've defined the type of assets that we like in those particular zip codes, we then have another algorithm which uses about 90 different data points to risk score each individual asset. So let's say there are 5,000 assets that meet our buy box in any given city that we're interested in. We will be able to very quickly risk score those 5,000 assets and say, okay, these are the 200 assets that we think are the least risk for this market, and we want to concentrate our efforts on purchasing those assets. So we're very data driven in our approach to purchases.
Interesting. So these assets that you have narrowed down, are they on the open market, or you're finding out which assets are best and then you're making offers?
We are source agnostic, so we will purchase assets that we think are good investments from any source. We are partnered with some of the more new age online platforms. We use traditional brokers. We even from time to time come across clusters of assets that institutions may be offloading. And then sometimes you hear of really interesting off-market deals where if you've got the network and a particular geography, and that's where I think learning over time as you get more familiar with different markets plays a big part. And it also talks a little bit to that commingling of properties that are available for rent versus those that are owner occupied. So for example, we bought a couple of properties recently. One was not an asset that was in the rental pool, single family rental market before. It was an asset that was being sold by the children of the owners after they had passed away, regrettably. But it just came onto the market, and it was a great rental asset, and so we purchased it.
Excellent. So you mentioned Pittsburgh and Atlanta. Are you expanding to other markets? And if so, when?
So we're already in flight on purchasing assets in a couple of additional cities in the US. As I mentioned earlier, we know the 20 cities that we will likely grow to over a period of time in the US. So those will be coming online, within the next few weeks, and will be available for our members to invest in. And then we're also going deeper in the UK. So we've just purchased our first set of houses in a second city in the UK, and those will be available on our platform in the coming weeks as well.
Excellent. So I hear you have a new data product that's launching in June. Can you tell us a little bit about that?
Our data product was, again, just kind of need driven, based on our experience and feedback from our early members that came in. There's a lot of noise in the market, with lots of different perspectives and viewpoints. And there's also a lot of data around, but it's very fragmented. We heard time and again, wouldn't it be great to have a data source which provides a hygienic view of, number one, what data is relevant to building a portfolio for our members? Why is it relevant, and what does it mean? So that's what we're putting out there. In a few weeks, our members will be able to see a very clean view, which includes Plotify's own proprietary scorecards and indices around investment destinations, including the data that we look at in those cities to drive our investment decisions on behalf of our members, and then just supporting our members with information that's going to make them smarter investors over time. So it will include data and news sourced from various different sources across the market.
Can an investor bring a property that they already own onto your platform?
Yeah, they can. And again, that was something that happened quite organically as we went live with our first set of members. I remember actually specifically one of our members who had purchased a couple of investment properties on the platform really enjoyed the way he could see his portfolio building on his Plotify account. It's really a nice, clean way of understanding your returns and what the asset is doing. And he came to us and said, "Hey, this is great, but I have a few other investment properties that I've owned since before Plotify existed. How do I get them onto Plotify, and so I can see them on my portfolio page the same way that I see my houses that I bought through Plotify?" So we started piloting what we now call Plot as a Service, and that allows our members, and in fact soon anybody, to bring their assets that they already own. And there are two forms of this. One is a light version where we will take all of the financial data related to their investment property, cleanse it, and present it to them on their portfolio page so they can get a really good understanding of their returns from their investment property. And the second is a full service asset management product where they can literally hand over the property to us and say, "I'm tired of managing this. Can you do it for me?" And that wraps in all of those things that I talked about earlier on.
I love it. So as we wrap up, where will Plotify be in 5 years?
First and foremost, we are squarely focused on continuing to provide value to our members, make it easier for them to invest in properties and manage their properties. And we're experiencing more demand because we're focused on that. But our vision is to really be the one-stop shop, end-to-end platform for our customers, where they can come invest in properties, not have to worry about any parts of the management, including one of the areas actually we didn't talk about, which is that we also do provide mortgages directly to our members, which interestingly I think are for the first time true point of sale mortgages, where our customers don't have to provide personal guarantees, and they don't have to have hard credit pulls, and they're wrapped into the structure as we offer them to our customer. So we see that expanding as a business line. We are already seeing demand from members in more countries across the world wanting to buy assets in the US and the UK. So I expect that growth to continue as well.
Interesting. Okay, now I have to ask a follow-up question about that mortgage product, because that's really interesting to me. Yeah. So how exactly does that work?
So this goes back to again the vision of Plotify when we started. As we were conceiving Plotify, we really just wanted to think about everything that an investor would have to take care of themselves. What are the pain points? And of course, one of the biggest pain points in purchasing an investment property, unless you've got piles of cash lying around and you're an all-cash buyer, and even if you do, it makes sense to finance investment properties for many different reasons. But the financing process is tedious, archaic, and adds layers of friction to any investment. So as we were conceiving Plotify and our unique structure, one of the things that we were really set on trying to solve is how do we allow our customers, our members in the US and outside of the US to take advantage of leverage on assets that we've effectively already underwritten and we think are really good investment properties, without having to go through that tedious process. And actually, the story goes that when we created our structure, we went to talk to lots of different lenders that we know and we've known over the years, pitched our product, and everyone kind of said, looks great, please prove it out and then come back to us and maybe we'll partner with you guys to provide mortgages. At that point, we made a decision to become a mortgage lender ourselves. So what we do is, at the point that our customer is ready to invest, they've set up an account on Plotify and they're ready to go. Let's say you, Deirdre, want to buy a $100,000 house in Pittsburgh as an investment property. Because we've already selected that asset and we've actually purchased it and structured it and made sure there's a tenant and insurance and optimized from a tax perspective, we will then go ahead and provide a 60% loan to value mortgage to the investment property in a structure that you do not have to provide a personal guarantee. And we're comfortable doing that because not only have we picked the asset in the first place, but we're managing it on behalf of our customers. So we've got eyes on the risk of that asset, not just at point of purchase, but on an ongoing basis. And that's proved to be a really valuable component of our product so far. Our customers don't have to take it. They can opt to purchase in cash and in some cases finance themselves through alternative structures, but it's certainly one that's proved to be very valuable.
I think so. Well, thank you so much for your time today. Where can people learn more?
They can follow us on LinkedIn and Facebook and usual social channels, or go to our website, which is plotify.co.uk, or they can connect with me directly, and I'd be happy to talk to them.
All right, great. Thank you so much.